Hello again, guys. 3.2 sources of finance, another one of our revision videos, which again, hopefully, you find useful. Good luck with it. Thank you. Starting point, two basic definitions: capital and revenue expenditure. Capital expenditure is any money spent on the purchase, transportation, installation, and commissioning of a fixed asset. So it's not just the cost of the fixed asset itself. Think about legal fees associated with the purchase of large-scale fixed assets. Think about if you were buying very large machinery that may need to be transported from another country. Again, additional cost that goes on top of the purchase cost. You may need specialist technicians to travel with that machinery to install it, commissioning it, making sure it's ready to use. So all of those costs are counted as capital expenditures, not just the physical cost of the asset on its own. Add all those costs together to look at the total cost of that asset. It all counts as capital expenditure. Revenue is just money spent on day-to-day operations of the business, stock, power costs, etc. If you're attempting to raise finance for your business, either as a new startup or start your business, or you're an established business looking to grow, it's either internal sources or external sources. And you need to think cost, time period, and risk. Now, the three internal sources on the syllabus are your personal funds for sole traders, so it's your savings, redundancy payments, you may have lost your job and you received a large payoff and you've always wanted to set up your own business. Your family may give you money free of charge to help you set up a business. Now think the fact that that is no cost. It's money you own yourself. That is low risk. You're only basically risking your own money. Compare that to taking out a loan, a large scale loan, which may be linked to your assets. So if you do not repay that loan, they can seize your assets, your house, your car, anything else you have of value to repay that loan. So personal funds, low risk, no cost normally. Retained profit, that's money you've made from previous years. So if an established business, the last 2-3 years, you've made large profits and that's retained in the business. Now link this to financial statements. When you revise your financial statements, look at the bottom of the balance sheet. There will be a reserve section. That is your retained profits built up over the years. That can be used as a source of finance. Bottom of the profit and loss account, the appropriation section. Whatever's left over after paying dividends and paying tax, interest, etc., is transferred to that reserve. So you build up your retained profit, the more successful you are. Now again, that is no cost, it's your own money. No time period to worry about. It's a 1 year, 2 year, 5 year loan you have to pay back. Again, low risk, no risk. Sale of assets. Now the only issue to look for here in business, if you're selling assets which logically you should be using, that's normally a sign you're in trouble as a business. That could send negative messages out there in the business community. So you may find suppliers less willing to grant you trade credit because they may believe you're in trouble as a business that could have liquidity issues and your ability to pay their bills. If the asset's no longer of use, it makes logical sense to raise money. Now, if you're selling something, it's your own asset. You're raising large amounts of money at no cost, and you don't have to worry about time period. Now, if you move to external sources of finance, they tend to be larger amounts of finance than you could raise internally, unless you're an exceptionally large PLC. So look at the first one on the list, share capital. Very basic idea. You sell shares in your business. That's great. Somebody pays you money for a part of your business, a percentage. But hopefully you've come across the terms divorce of ownership and control, from control here, and dilution of equity. Now you may have set up as a sole trader and become very, very successful and decide to register your company as a limited. Now, yes, you cannot advertise your shares for general sale, but even with a limited company, if you bring in other shareholders, suddenly you owned 100% of the business, now you've sold off part of that business. Once your ownership of the business falls below 51%, you've lost control. So the more and more shares you sell, great, you can raise large amounts of money, but the less and less control you have, and more external influence you have on your decision making. Again, is that an advantage? Is that a drawback? You may be bringing people in with lots of experience who are buying shares, or there may be just people who are silent investors. But they can vote at annual general meetings for PLCs, for example, and influence your decision making. Dilution of equity is a phrase which links to divorce of ownership and control. Now, dilution simply means your equity is your worth of the company you own. So the more shares you sell, the lower your shareholding becomes. You start with 100 shares, you own all 100 shares. If you issue another 100 shares, you've suddenly got what, 50%, etc. Now, your equity holding falls. Now, for some investors, their influence will fall and they may decide to sell. If you're quoted on a stock exchange, the share price is an important indicator for external stakeholders, normally the health of the business. If you have large exodus of shareholders all selling their shares due to, I don't know, they've lost faith in you, you're issuing too many shares, they're worried about the financial structure, that could lead to falling share prices, which again could lead to issues with raising finance with banks. On a larger scale, PLCs, some PLCs have loans which are linked to share prices. The share price not falling below a certain level. If not, you've got issues with the banks calling in loans. Also, share capital. If you have lots of external investors, particularly in the UK, we suffer from short-term decision making. The institutional investors, that's the large-scale insurance companies and pension funds, are looking for short-term profits. So if they're finding very successful businesses they want to invest in, yes, they may put up large amounts of capital, but they're looking for a quick return. So that could influence your decision making. Again, signals to markets. Even though a pension fund may only own 10-15% of your business, if they decide to suddenly sell the whole of their shareholding, that could cause issues in terms of confidence in your business. If you move on to loan capital, questions. Fixed variable interest rates. Now, this goes to, as you'll find at the end of this, the appropriateness. The only real issue you'll have in terms of exam questions, they'll provide you with a scenario and you have to select the correct sources of finance for the situation. So look for factors like economic circumstances. At the moment, globally, there's an inflation problem. If you look at the external environment, there was a global pandemic. A lot of economies have begun to recover. Then there was Russia's invasion of the Ukraine and the impact of the global economy, inflation, and the standard response to inflation is increasing interest rates. Now, issue, liquidity, gearing. If you have variable interest rates on your loans, each occasion the base rate goes up, normally your interest payments will go up. If your interest payments go up, that's an increase in your cash outflows, which could potentially cause liquidity problems. Also, link that to your gearing. Now, with a loan, think about time span. Now, if you're a new startup or a business in its early stages, it may be logical to take a loan over a longer time period, because in the short term, that will allow you to have lower payments each month on the loan, i.e. your cash outflows will be lower. Over the term of the loan, i.e. how long it takes you to pay it back, you'll pay back more money, high interest payments. But to protect your cash flow, you may decide to go for a longer time period on the loan. Now, also, flexibility. Look at what's an offer in the market. Are there any penalties? Take a loan, which may be over a longer time period, but if you have more confidence your business is established, you could change that loan. You could exit that loan at low to no penalties and go for a shorter term loan and pay the loan back in a shorter period of time and pay less interest. Now, overdrafts. Your major problem with overdrafts are the cost. They're very expensive. What they should be is a short-term source of finance, offer you flexibility. Now, for example, if you're a seasonal business and the off-peak tourism, you may use an overdraft for 1, 2, 3 months just to fund your business. Now, that's fine. Why? The cost is relatively high. If you're using your overdraft continuously to fund your business, okay, that will massively increase your cash outflows in terms of charges. Also, an overdraft is normally only granted for a 12-month period. The banks have to renew the overdraft every year. Now, the problem is if the banks decide, having looked at your business over the previous 12 months, looking at your inflows and your outflows, they think, hang on, you are at potential risk of failure, they can call in the overdraft. That's why you have recall and non-recall overdrafts mentioned here. A recall overdraft facility is they can ring you up normally and say, we're calling the overdraft. Now, you may have 2, 3, 400,000 pounds, dollars, euros in terms of an overdraft. An overdraft simply means you're using the bank's money, you're in negative on your bank balance. They're allowing you to use their cash. Now, that normally means you've got 24 hours to repay the overdraft. If not, court proceedings will start for non-payment, and from then, basically bankruptcy when most businesses are not in that position to repay it. It is possible, if you're going to look at using an overdraft for a prolonged period of time, have a non-recall overdraft. That's where you normally pay higher fees, higher charges, but they guarantee not to call it in. They'll work with you if they feel that your business is in trouble. So look for flexibility, look for using an overdraft purely as a short-term source of finance, just to tide you over as a business. Now, trade credit, that's where you are supplied with goods or services on credit. Now, it's 30, 60, 90 days are the normal standard terms of trade. Now, that helps your liquidity, and this links to the working capital cycle. So when you go back and look at the working capital cycle, think about trade credit. How useful is it? It is. But the problem you have in the working capital cycle, you could be relying on a debtor paying you to provide the liquidity to pay your suppliers. So you have to think and try and negotiate longer periods with your suppliers than you have with your customers. So ideal situation, you would have customers who pay you in 30 days, but you have, say, 60 days to pay your suppliers. And that gives you leeway if you're having problems chasing customers to pay you before you have to pay someone else. Because obviously, don't have the money to pay, you've got problems, suppliers will come after you in terms of non-payment. Now, a grant is an amount of money given by governments, local governments, etc., normally used to encourage businesses to locate in certain areas where there may be high unemployment. Maybe to encourage you to invest in, say, renewable technologies. Look at the green agenda. Now, great. How much money are they giving you? What are the conditions with that grant? Are they repayable? Is it free money? Do you have to stay in one location for a certain length of time? Okay. What is the time span in terms of payment of that grant? Is it all paid in one amount, or is it paid in 4 separate installments? Now, all of those are issues you need to consider when you're applying for grants and or thinking about using them as an external source of finance. Now, the remaining external sources which are on the syllabus. Subsidies. Subsidies are an amount of money granted normally by governments or local governments, business authorities, aimed at production. It's per unit. So each unit produced, Now, you can use this for education. So students, in the state sector, more students you actually enroll in your school or college, the higher the payment to you. Each student is worth X amount of money. Now, subsidies are great. How long are they going to last? Use a current example. One of my favourite bugbears, that stupid idea that was Brexit for the UK. The farmers were paid subsidies by the EU, which basically kept a lot of farmers on the land. Now, that was to produce the new subsidy regime on offer by the UK government. It's far less generous, and a lot of farmers are now wondering, is it worthwhile continuing? Now, obviously, lose your food supply, it's a problem. Subsidies could be useful to meet your objectives locally, government, local government, etc. From a business point of view, is it worth the while? Is it short term, 3 months, 6 months, 12 months, 2 years? How much? What are the conditions? Is it paperwork? Is it bureaucracy? Is it going to take you lots of time, lots of conditions you need to meet? Will it inhibit you in terms of your decision making? To take that money, you have to follow certain rules, regulations, which may stop you following the path you want as a business. Now, debt factoring. Keep it simple. This is where you sell your debt to a third party. So if you're using trade credit and you're supplying your customers on credit, if you need to raise finance quickly, you can sell your invoices. Now, debt factors are normally companies which are offshoots of the main banks, but there are others around who do this independently. They would normally, again, terms in the UK, provide you with 80% of the value of the amount you owed on that invoice straight away. Now, that's the advantage. Say, for example, you have suppliers to pay in terms of your trade credit working capital cycle, but the customers you were expecting to pay hadn't paid. So you've got other customers who may have 30 or 60 days, sell their invoices. Why? You need that liquidity hit now. Now, benefit, normally the debt is passed on to the factor. So if the customer doesn't pay the invoice, it's the factor's problem. You keep the 80%. Now, if the customer does pay the factor in 30 or 60 days, normally you receive another 10% of the invoice value. So debt factoring can be expensive. It can minimize your risk of going bust by being able to raise finance quickly and protect your liquidity position. But longer term, you should not be using it similar to the idea of an overdraft. It is just to deal with specific problems, specific issues at that point in time. Now, leasing's become a far more popular way rather than buying fixed assets. Now, lease an asset, be it a car, be it a machine, be it a building. Why, instead of paying large amounts of capital up front, i.e. straight away, you pay monthly installments for a particular period of time? That helps your liquidity. Yes, you don't own the asset, but think about depreciation, particularly with vehicles. Most countries I've ever been to and or worked in other than the UK, everybody suffers from the same problem. Cars, the largest loss in value is the first 12 months. Now, if you lease your fleet of cars for your business, at the end of 2 or 3 years, you simply give them back and take a new set of cars. Now, additional benefits, a lot of the car hire, they will offer free servicing as part of the lease package. They may offer insurance thrown in as well. There can be possible tax incentives as well. The cost of lease you can claim in some countries as a taxable expense to reduce your tax payments. But leasing far more popular than actually purchasing. Now, venture capital and business angels, a lot of students tend to get confused between what's the difference. Be honest with you, business angels tend to be individuals. Venture capitalists tend to be firms. Large firms going around. In essence, they look at the same approach. You're looking for either failing businesses which can be turned around, they can invest and buy a stake in a very cheap price, or they're looking for new business startups. Now, from someone looking to start a business who may be high risk, the banks may decide, no, we won't provide the loans. You cannot raise the finance anywhere else, but you've got a really good business idea. So go with business angels, venture capitalists. Benefits, these guys bring not only money, but also track record of success, business experience. You are now able to start your business. Why? You have the finance to start the business. You have the finance to expand your business. Issue, they're looking for a piece of your business. If they buy 15, 20% of your business now, they're looking 5 or 10 years. If you're successful, as they believe you will be, that 15 or 20% is worth 10, 20, 30 times the amount they've paid. Now, you can either look to buy that share back at the time, you can put that into the deal, or the venture capitalist business angels basically sell off. So again, loss of control, divorce of ownership from control. Think about external influences, external stakeholders. Now, last issues on this section of the syllabus. You need to be able to understand what's short, medium, and long-term finance. So loan capital. Some people do take 12-month loans, quite high risk. Long-term loans, that's things like mortgages. Are you taking a loan for more than, say, 5 years? Make sure you can identify which of the sources are more short, medium, and longer term. That will dictate cost, that will dictate risk, that will look at liquidity, gearing, etc. Now, on the syllabus, the actual attack, if this appears in the exam, the appropriateness, this is where your assessment objective 3 comes in, analysis and evaluation. So it's back to, here's a scenario. Okay, how should they finance this? Now, invariably, it's not one particular source. Look at what you're given. So if you say had retained profit, you would normally not use all of your retained profit. You want to keep some retained profit as a contingency in case there's an issue in the business. So you could use, say, 20% of your retained profit. Why? Justify it. That's no cost. That's no risk. It's your money. Okay? You could therefore look to raise the rest of the money required for the investment via a loan. Okay? What are you going for? Fixed variable interest rates, flexible early repayment options, no penalty exit if you can repay in a shorter period of time. Now, look to justify, look to be logical. Do not, as I put there at the bottom, as I once saw in an examination question in my examiner time, raise $500,000 finance investment. Somebody suggested an overdraft. No. Most ridiculous thing you could actually do using an overdraft to fund $500,000 investment, writing a check. Again, hopefully this has been useful. Keep on looking at the YouTube channel. We're here to help you guys.